Good morning, everyone. This is Dr. Stanley Okoro. I'm actually live from Lagos, Nigeria today. It is 11 o'clock on East Coast and 4 p.m. in West African time in Lagos today. We are live today on our 29th ANPA financial webinar. I'm really excited about today's webinar because we're going to be talking about something that affects all of us. Today's webinar is brought to you live by ANPA and ANPA Foundation, co-sponsored. And our co-host today is Dr. Wasi Adisa, who's the ANPA chair for Georgia. I'm your regular host, Stanley Okoro, president for ANPA Foundation. And I'm going to bring on our national president, if he's on. He's on time. Oh my God. Oh my God. This is that there's hope. There's hope. We're good. All right. Dr. Cliff Eke is our ANPA national president. He's going to talk about ANPA briefly, and then we'll talk about ANPA Foundation, and then we'll start the presentation. Cliff.
Thank you, Dr. Koro, and I've been here for over 2 weeks. Sorry, my camera is moving. Thanks, everybody, for joining this webinar. Very important webinar indeed. Tax planning, 2024 year-end tax planning. I complain to everybody, my challenge is, one of my most difficult challenges is taxes, something we all have to do. However, we don't want to do too much if we can help it. Let me use the opportunity to thank Dr. Koro, president of the ANPA Foundation, and for this continuous webinars, teaching us. This is the 29th episode. It's amazing. It's like it just started. And we'll continue to do it. Also, shout out to Dr. Wasi Adisa, our Georgia chapter chair, for sponsoring it today. And then, of course, our friend, Dr. I'll call him Doctor. We'll give him honorary doctor, even though he's MBA and CFF, our ANPA Foundation, ANPA friend, Enyi Kano, and his group for always being part of this process. And special thank you to Nek Anwobi, MBA, CPA, who is our subject matter expert today. So without much ado, ANPA, as you know, is a 501c3 nonprofit organization. And really, our vision is a healthy Nigeria and America in a healthy world. And part of health is your financial health also. And this is very important to us. There are other things going on in ANPA. In November, we have our board retreat coming up in Palm Beach, Florida. Enyi, I hope you and your team can be there. As well as next year, ANPA will be 30 years old. So we're celebrating this in Nigeria with our usual ANPA week and convention at Echo Hotel, April 2025. Okay, Dr. Koro, let me hand it over to you. Thank you, sir.
I am currently at Echo Hotels right now, checking out some things. We're going to make sure that April 24 is going to be a success. But for those who don't know how to contact ANPA, this is how you engage with ANPA. We're everywhere. ANPA Foundation was founded by ANPA in 2022 for three main purposes: to raise funds, create financial independence for ANPA via philanthropy, estate planning, and business investments. We also to create sustainable system of healthcare in Nigeria and beyond. And the third thing, which you're here today, to educate ANPA members about personal, business investment, task strategies, estate planning, multi-generational wealth, legacy, and philanthropy. Again, this is a co-sponsored event. This event is initially scheduled at 12, but we had to move it today to 11 a.m. due to a conflict. This is an intentional aggregation of subject matter experts. We think this is the highest and best use of your time. Is free to ANPA members, another benefit of being an ANPA member. The materials presented at all ANPA webinar is for general educational information purpose only, and it is solely the opinion of the presenter. No webinar is intended to provide personalized financial or legal advice. It is left to the discretion and the judgment and it's the sole responsibility of you to determine what's necessary for you or your own practice. Neither the speaker or ANPA can be held responsible for the materials, opinions, or any inadvertent errors or omissions in the preparation or presentation of material. Furthermore, nothing in this material should be construed as an endorsement by ANPA. Without further ado, we're going to introduce Dr. Hi, there you go.
You're like me now. Before you continue, Dr. Adebola Giwa, please turn off your camera. You know you're getting ready for something. Just for your own privacy and protection. If you can hear me, turn off your camera. Okay. Over to you.
Okay.
Go ahead.
Thank you. Any Carol is an MBA. He's a friend of ANPA. Everybody knows him. He is a speaker, a thought leader, an author, entrepreneur. He's our ANPA financial advisor. He has been on this webinar more than anybody else except for me, and Dr. Cliff. But he's a financial expert, well recognized all over the world. And he is my financial advisor. So I'm happy to welcome Enyi to the platform. Enyi.
Yes, Stanley, thank you very much. If you can go on to the next slide. Thank you again. Welcome, everybody. Go on to the next slide, if you will, please.
I have. It takes time.
Okay. I forgot you were coming in from Nigeria.
Yes.
Well, you all know that what we basically bring to you is expertise. Everything we do is powered by expertise. And today, I could not be more excited about our featured expert. And I think when we talk about how you'll understand why. But we have a virtual family office platform where we provide tax planning, risk mitigation, wealth management, legal advisory, and business advisory services. This is a small sample of some of the experts that we have in our ecosystem, and it's national in terms of bandwidth. Next slide, please. Nneka is, and I haven't seen the slide yet, but as you can tell, she is a CPA, MBA founder. She's an entrepreneur, founder of RCN CPAs and Business Advisors. She has worked with major brands. She's worked with the Microsofts of the world and the Deloitte Touches of the world. Nneka is a tax planning expert. She's got approximately 30 years of experience, and that's what we're standing on today. Nneka has global expertise and experience. She has consulted with companies in different parts of the world, different continents, 4 continents, 14 countries. She has received a number of awards: Microsoft Circle of Excellence, Rutherford Chamber Businesswoman of the Year, and she is a philanthropist. She runs Inspire Foundation. I think Inspire speaks for itself. And at this time, she's continuing her learning. We have a saying, if you're willing to learn, no one can stop you. If you're not willing to learn, no one can help you. Nneka is pursuing a doctorate degree in high impact entrepreneurship. Nneka, I'm going to let you take over and share your parroted wisdom.
Thank
Next
you,
slide,
Enyi,
please.
for that great introduction. I appreciate that. And thank you to the leadership of ANPA. Thank you for the opportunity to present today around tax planning. I'm grateful, and to all the other members who are online and will be listening. Kudos to what you're doing in ANPA. I recall just an incident of just, your practice and your profession. When I had my first practice, 2003 in Murfreesboro, Tennessee then, I did have a pretty large client, a cardiologist. And I believe at that time I kind of had just started, and either I prepared a return, had submitted, and I realized that, oof, there was a mistake I'd made. I had taken some deductions, and I was literally so concerned, really worried, that I called up my mentor, David Compton, who had a massive practice in Mississippi, and letting him know, hey, I've done this, what am I going to do? It's all myself. And he said, you know what, Neka, the good thing about accountants is that we can always amend returns. Unlike a cardiologist, if he had made a mistake, could have lost a life. So I really honor you physicians and who are in the business of helping save lives every day. I can't begin to compare to ours that if I make a mistake or any of your accountants make, within 3 years, you're still able to make an amendment to that return. So again, thank you for the opportunity to spend the next 50 minutes with you. The plan I have is to speak for about 25 to 30 minutes and then take up some questions and answers. Why? Because I know that there are different physicians here. You have your business, you're a physician entrepreneur, you're a W-2 earner, or you are an independent contractor. So you may have different questions. And really, tax strategy is it's not like one size fits all. There are different questions that may not relate, or things I may say that may not relate to somebody else, but then a question you have, then I'll kind of know how to address that. But generally, with what I have here, there are a couple of things that I know that at the end of this 1 hour together, you will have got 1 or 2 insights that you can immediately apply to that. So I'm going to talk today about really common mistakes that physicians make that could literally cost you thousands. You may be aware of some of them, or you may not just be. Next, please. So first of all, or I guess before this is, are you satisfied with the taxes you pay? Whoever is satisfied, right? Do you think you are paying just enough or more than? Most people will say, I think I'm paying a lot of taxes. Usually at the end, hopefully, you're not so surprised, right? At the end of the year, because if you are, then you have not done some things that we're going to talk about. It is good to pay taxes, at least your fair share of taxes, because what that means is that your income is growing. But it's about paying what is the minimum, right? Not leaving dollars on the table. I mean, the good news is that really you're right in terms of that, yes, you're paying, but then there are different things that you could do to mitigate around that. That's what we're going to talk about in this next 20 minutes. Next slide. So generally, because of the little time we have, these are probably the 10 most expensive tax mistakes. And I would narrow down on 3 today. One is failing to plan, and that's what I'm going to talk about. The second is around audit paranoia, and we call that when you are so concerned about taxes that you're not aggressive and you do not have a strategy in place, or your accountant says, oh, you can't take this or that. I had a session with a business professional who was saying, oh, her accountant says she could not take some expenses related to training. She could not take some other expenses, right? And these things are actually legal. Of course, there is also statistics in terms of types of entities that are most heavily audited, right? And one is really Schedule C, which is sole proprietor. So S Corp is also increasing, and that's also a result of reasonable compensation we're going to talk about. Another is around the wrong business entity or the type of entity that suits where you are. I'll talk a bit about that. One is around missing qualified business income expenses. If you don't know that, I actually have a summary of all these mistakes that you can download later on, and I'll share the link for that so we don't spend too much time around that. I'm also going to talk about wrong retirement strategy. Missing family employment is one of the also major mistakes that most entrepreneurs, this doesn't really apply to W-2 earners, but independent contractors or corporations, right? And when I say corporations, a C corporation and S corporation. I'm also assuming that you understand some of these entities. If you don't, please just put something on the chat so that I know when it's time for questions and answers, I can just comment on that. How well are you utilizing your family? You know, are you able to employ them in some manner so that you can actually shift some of your income to those lower income brackets. Another is missing medical expenses. What kind of health reimbursement plans do you have? How can you deduct, for example, your daughter who's going to take braces through your business, right? So that's also another area that physicians or business professionals are not taking. Another is missing home office expenses. That's another main area that that professionals do not take, right? Most of us after COVID have some kind of home office at home, and you can deduct literally almost all the different lines of expenses, making use of the size of business, size of your office space as compared to your to the whole home. Again, I have more information about that in the download summary. Another is your missing car, truck expenses. And that in this case, you have to have a plan. I have a client who has a McLaren, right? And it was now like, how can we deduct my McLaren or what? So there are ways you can strategize to deduct some of your car or truck expenses. And then the last but not least is business meals. Of course, there are many other strategies as well that I've not listed. If I just keep listing all of them here, it would take us probably more than 2-3 hours, and some of them may not relate to you. Next slide. So the summary download, I'll post the link in the chat after that. So I kind of interspersed some of the, because this is kind of technical, you know, just some trivia or jokes, given that it's early in the morning and we're learning taxes. So next slide, please. So why did the neurologist make a terrible tax accountant? Well, the answer here is can you move back to, every time he saw a loophole, he had an urge to close it. So neurologists kind of focus on yours and we accountants will focus on ours, right? So that we can look for all loopholes. So the opportunity here is, where are the loopholes, right, in the tax law? That's our objective. And that's kind of what's, you know, there are tax accountants and there are tax accountants. There are accountants who are reactive, who work with, don't deduct this, don't deduct this, don't deduct this. There are also proactive business people who work with, who look at the tax law and look at where are their loopholes, right? And so this is the opportunity that presents itself. We are not going to go against the law, but we're not going to evade taxes, but we're going to ensure that we maximize all available tax deductions. Okay, next slide. So the first mistake is really failing to plan. The Supreme Court Justice said there's nothing wrong with a strategy to avoid the payment of taxes. The IRS tax code does not prevent that. So a question I'm going to ask you, how much time do you spend on planning for taxes? Dr. Eke had mentioned that taxes are one of the high items, right? And if you look at your line item, a large percentage of your income. In fact, when I look at other physician practices, apart from your cost of labor, right, and maybe medical supplies, the next line item is probably going to be your taxes, depending on what tax bracket. In fact, it's probably more if you're on the 37% bracket, right? And you find out that, you know, or a lot of, I'm not going to say do not look at it until October, or let's say April or May, and you get a tax bill without looking at what happened. Why am I paying this amount? Now, when you're asking what happened, why this pay amount, it's a bit too late. You can't do anything about that because that is just preparing. Or you go to an accountant that is a preparer and not taking the time to plan. So this is a number one mistake that most business professionals make. And we know the common saying that if you fail to plan, that means you've planned to fail, right? And that means whatever you get, whatever is on the line tax liability, that's what you got to pay, because there are many things that you can do after the event. And this is the best time, October. In fact, this is usually my very busy season, from October to about the 20th of December. Strategies that will enable you reduce your taxes can be put in place. After December 31st, you are then looking at you are now looking at really if you're not able to pay that money up front, you're having a payment plan. So we ask, why tax planning, right? I would say there are two ways to making money. One is financial offense and the other is financial defense. Financial offense is when you are looking at trying to get more patients, or for W-2 income, trying to get a moonlighting and additional income, maybe doing some part-time work and all that to increase your income. Financial defense is when you are now looking at saving money, and it is really the key to financial defense, where you are ensuring that you are spending less. And really, as I said, taxes are the biggest expense. Tax plan is important because it guarantees results. I'm sure several of you are investors, you invest in maybe the stock market and all that. You can guarantee, you not necessarily, before, one slide before, yes. With tax plan, you can more or less guarantee results. If we say that, hey, you're going to, for example, use the Augusta rule, and you are going to pay yourself, for a homeowner or a business owner, 14 days to use your home as to do your tax planning, your corporate meetings, immediately you can see the effect on that. For a W-2 earner, ensuring, for example, that all your deductions, that you're using itemized deductions, or even considering getting rental property or something to be able to minimize your or maximize some deductions. So tax planning more or less guarantees risk, because it said if this is the amount you're going to deduct, if you're on the 37% bracket, you are making, for example, 37% of 50,000 is about $18,000. Right there, you've saved some cash, and that's more money in your pocket. Next slide. Okay, so let's just a brief summary of how the tax code works. There are about 2,700 pages of tax laws, different laws. And within the IRS, the red lights are places where you have to stop and pay tax. This includes like Section 1. And what Section 1 is where you lays out the tax bracket, and I'm going to show you what 2024 tax bracket is. Or Section 1401, which outlines self-employment tax rules. There's nothing you can do about it. There's a tax percentage. If self-employment taxes, you pay 15.3%, of which half, if you're an employee, half is paid by the employer, half is paid by the employee. Or Section 1411, where it's the new net investment income. There's a certain amount of investment income that you earn, and you pay taxes on that money. The next slide, but very quickly, the code runs out of red lights, right? Where, okay, I've talked about it. Sorry, next slide. Next slide, please. Can you go back to the previous one? Sorry. Oh, yes. Okay. So the green is where you can pass through without paying taxes. So I've just said red light, you're earning money, you stop, you pay your tax. The green, where it's like you go and you can move on without necessarily paying taxes. An example is, I talked briefly about the medical expense reimbursement plan. Do you have one in place? If you don't, what's the entity or the structure you can use to do that? For example, to be able to pay medical expenses, charitable contributions. How are you maximizing your charitable contributions? If you're a business owner, do you have a foundation or a non-for-profit where you can channel some of your contributions or your donations through that? ANPA, are you maximizing that amount? And even if you're a W-2 income earner, there are ways you can actually have like something called a charitable remainder trust. There are ways you can maximize your charitable contribution to be able to reduce your taxable income. Another green light is tax-free, Section 7702, which is like the cash value life insurance plan, tax-free loans and withdrawals. So these are things, and this is how you can see that the IRS have things in place to actually enable you to maximize your tax deductions. Next slide. So most tax professionals are busy doing taxes. They focus on the red lights. And the key is that If you pass through the red light, guess what? That's when red flags come in. For example, you are not paying your, if you're an employee, you're not paying your self-employment taxes, right? Your W-2. And I'm also thinking of S-corp owners who don't pay reasonable salary. I'm going to talk about that later. Meanwhile, there is the green light accountants who focus on ways you can go through, pass through, without having to pay taxes every point in time. Next slide. This is the tax bracket for 2024. You can see that very quickly for high income earners, you are around the 35% mark, 24, 33, 35, and 37, right? And so once you've subtracted your standard or itemized deductions, you have your taxable income, in which case, really, it is whatever it is. If your income is like 200,000, you look at the bracket where you are and know that this is the amount of taxes you have to pay, right? The question I usually ask is, what is your effective rate? As entrepreneurs and high income earners, it's your responsibility to know what your effective tax rate is, because that's one of the keys in how you reduce taxes, one of the tax strategies. How do I shift my income, being a 35 income earner, to a 15%? Because nobody's going to be at 0% or 10%, right? You can see that 12% is only $23,000 for joints. Next slide. So the bottom line really in how you cut taxes, 4 things. One is the timing-based strategies, using things like 401k deferrals, right, or simple IRA to defer, to shift today's tax bill to tomorrow. And that may not always be effective, again, depending on where you are, right, in terms of your income. So not one size fits. So if there's something I'm going to leave with you today, is that there is no one size fitting all for a tax plan, right? The other is income shifting strategies to move taxable income to lower bracket taxpayers like your children. So usually I would ask, if you have a business, what are your kids doing, right? Are they earning income? Even if they are not, what are ways we can put them in for us to shift income from the 37% to 10% to 15%? And then, for example, that salary can be put in a Roth IRA or some tax saving plan. The next is the code-based strategy, which is, I talked about Section 105, like the medical reimbursement plan, the Augusta rule, different section codes of strategies that are there that if you are not proactive, you will not take advantage. And the last but not the least are now like the solutions to help you implement some of these things, right? So for example, separate managed accounts, insurance, so like in Amy's team, kind of looking across that, different solutions to enable you implement whatever plan that you have now put in place. Next slide. So I've kind of talked about failing to plan. This was really all about failing to plan. Yeah, okay, so this is the next one. Why do surgeons hate filling out taxes? They get nervous about cutting too much, right, from the body. So that's why surgeons leave it to the last minute, because you may cut out too much. Okay, so let's move on. So the next mistake is choosing the wrong business entity. And a lot of people think that the fact that you've chosen one entity does not mean that you cannot change the entity based on where you are. So for example, you may be thinking, I'm thinking now of like a medical practice owner. You may be considering selling your business in the next 5 years or 10 years or something. The fact you have an S-corp does not mean that you can continue. At some point, it may even be better to use a C-corp, because the advantages for when you exit the business. That's why it's important to keep planning, to kind of have an idea. This is what I want to do in 5 years' time, in 10 years' time. So that the right strategy I put in place for you to achieve those goals, right? Okay, so I've talked about the fact that you create something doesn't mean that you cannot shift that. I won't dwell too much. I'm going to assume that you understand a sole proprietor, a partnership, and an S corp, but I will highlight a few things. Of course, getting started, you're a sole proprietor. I often see even some those who maybe set up a corporation, maybe like even a 1099 medical doctor, right, who is not W-2 and says, oh, I've set up an LLC. In the eyes of the IRS, an LLC is a disregarded entity. So next slide. A disregarded entity means that the IRS does not see you as separate from your business, even though the state where you have formed a corporation deems you apart. You still have to do several elections to make sure that you're an S corp. The same thing with partnerships, right? So partnerships, medical partnerships, you have like a guaranteed payment. There was a return I was reviewing and a partnership, and the employee or one of the partners was taking W-2. That is so wrong, and it's definitely a red flag. A partner receives guaranteed payment, which is treated as self-employment income. So you will have you will pay 15.3%, the employer and employee portion. But of course, at some point, there are some entities that a proprietor, Schedule C, can work. Even if you are like a 1099, there's a strategy you can use where you deduct almost all the expenses in a sole proprietor, because there are some advantages of a sole proprietor over the S corp, but it depends on what the goal is. Is when you say your business plan is, then a tax plan falls in, aligns with the business plan. So it's not good enough to have a business plan without having a tax plan aligned to that. Next slide. So just briefly, so proprietor, you report your net income on your Schedule C, and you pay income tax on your net income. Next slide. The self-employment tax we know is in 2024, if the first 168,600 plus 2.9% of everything else. And this is across board, right? So even if you are even if you are an S corp or an employee of your company, you will pay an extra 0.9% amount on amounts over 200,000, over 250. So at times in your 1040, you may see additional other taxes. That is additional taxes you pay because you have paid yourself over 168,600. So depending on even your salary, depending on your income, one may want to reduce your income so that you are just below the threshold to avoid these additional taxes, right? And spread the income across whoever is in the family, such that you are not tagged with those additional taxes. So you see, these are some tax strategies that you could put in place. Next slide. Next slide. A lot of you know about the S corp, right? Whereby you split your salary between your salary and then income dividends. So you're a business owner and you so happen to become an employee of the income of the entity, and you get a pass-through. There are definitely very many benefits of that. But again, depending on your size and even your income, and again, what you want to do, so at times C corps may actually also work, because remember that for now, the tax bracket on C corp is only 21%. So if you're in a 30-something%, that's already a 15% differential. And if you're looking at your selling at some point, it's not always S corp is the best. It depends on your current situation. Next slide. Because there are limitations right now of the S corp. So for example, your health insurance, you cannot deduct that. That's of a greater than 2% shareholder, right? So it's one looking at what some of the advantages of this and disadvantages and knowing your own unique situation. So you pay income tax on salaries, and then you just pay a minimum of your FICA, self-employment taxes on just a portion of salaries. Next slide. So the advantage of the income is that you save on because you've reduced your salary. So if, for example, your total business income was 100,000, you pay yourself 50,000 or a bit less, and then the other 50% is a flow through to yours, for those who are not aware of that. Next slide. Next slide. Next slide. There's something I want to highlight in S Corp. Yes, reasonable salary. This is a really deep red flag for S Corps. Reasonable salary, as the IRS says, is, for example, if you are working somewhere else, how much is that salary? Right? You don't want to have a $500,000 business and pay yourself $20,000 salary. You're working full-time in this business, and you should pay yourself something that is reasonable. The IRS have guidelines for what that is. And in the unlikely event of an audit, the IRS can come and reclassify all that income and put everything even as a W-2 income, right? So it's very important that you look at what you constantly look at what is reasonable salary, so that you don't have a red flag sticking out right there, and pay yourself either after the fact or along with the members of your among with the other employees, right? Of course, some owners may say cash flow and all that. You could always wait quarterly or towards the end of the year and create a W-2, and then not necessarily give yourself the net because you've been taking out the money from your account. So it's very important that you always look at what is a reasonable salary. Next slide. The third strategy is around wrong retirement strategy. One, I've talked about the failing to plan. The other is about the wrong business entity and a wrong retirement strategy. Now, we know that in America here, there's a 401k plan, always wanting to encouraging employees to max out on your retirement because they are tax deferred, right? Okay, so I just want to talk a bit, just looking at the time. When I think of reasonable salary, you kind of look about 50-50, or about 32% salary and about 70, depending on what your total income is, right? Because when they looked at an analysis of all, so I'm looking at numbers, the strategy I was talking about, it was about 32.13 of the split. But really, which is why, okay, I have that here. But ideally, to be honest, about 50-50. But then if you are now probably on a 5 million, or 3 million business income, then that can continue reducing, right? So always look at what's comparatively, again, such that you are just within the average. Oh yeah, so next one. All right, so I put number 5 here because along the 10 mistakes I have, this was the 5th one. So I picked out the ones that may relate to few physicians. So 2 primary choices for your retirement savings. One is the traditional retirement accounts, which we'll know, the 401k, the simple plan, the SEP IRA. So they give you an upfront deduction, but impose taxes on withdrawals, right? At age 73, there's what you call the required minimum distribution, that regardless whether you need the money or not, you must take the money. If not, there is a heavy penalty. So that's usually what is encouraged, but there is no blanket, because depending on how much income you're going to make down the line, that may not necessarily work for you. The second type of retirement is Roth. You may have heard the Roth retirement, which doesn't give you a deduction today, but lets you take out money tax-free. If I ask you which one do you think is best, right? Most people will say, oh, definitely the 401k plan. Next slide. The 401k plan. But it really depends. It really depends. If you think that you're going to earn more money, if you're maybe like on 150 or 200,000 now, and you know that your business, for example, is just starting, and I will be like $500,000, $1 million in the next 10 years. A 401k where you're paying 15, 20% right now will not serve you. So it's better than you put your money, you put your money in a Roth where you've paid the tax, and then down the line, you are getting that money tax-free, right? So as again, I said, no one rule fits all. It depends on your particular situation. So managing money through retirement is a cycle with 3 phases. There is the seed, which is your initial investment in the asset. Then there's the growth phase where that money is growing. And then there's the harvest, right? And you can pay or avoid taxes at each of these points, depending on the nature of the asset that you buy. And so it really depends on what your personal rate is at every particular point in time, which is why at the beginning I asked you, what is your effective rate? If you don't know, ask your accountant or check the comparison in your tax return. What is my effective rate? It is so important to know your effective rate, not even your marginal. Your marginal kind of now says, this is where my highest income is, but you should know your effective rate. Are you 20? Are you 25? Are you 28? Because that will now inform the different tax plans to help you to reduce that effective rate. Okay, so let's, next slide, please. So these are some of the assets that you're probably aware of. There's a taxable stock. What this means here is at the seed, when you are investing the money, for those who have brokerage accounts, you pay after tax, which is not a bad thing after all, because you are thinking of my income is going to grow later on. When it's growing, you may have partial taxes on that, and then also have, when I say harvest in taxable stock, when you sell it, you know, after a year, you have a lower capital gains, or you can also harvest whereby if you have capital losses, you can net that such that, and that's also a tax strategy as well for high W2 income earners. So I'm just putting different strategies as I think of it based, you know, as we talk along that. So that's partial. A traditional IRA, you see, that most people talk about, is good. At seed time, it's tax deferred. When it's growing, it's tax deferred. But when it's harvest time to withdraw, you will pay tax. So if you've made so much money, and of course our plan and our desire is to earn significant money at later stages, you will pay taxes on this. And the reason many years ago when they put this traditional IRA, because it was the assumption that you work so hard at the beginning, maybe in your 20s, your 30s, your 40s, right? And this is probably going to be your highest income, so that when you're taking that money, you would automatically be in a lower tax bracket. But it doesn't necessarily look, even for you all, I'm sure that you will earn significant amounts of money if you are just kind of starting your practice or just about to take off later. You will, where you're going to earn more at later stages. It then means the traditional IRA qualified plan will not suit you. There is the Roth qualified plan where the seed, as I said, is after tax. When it's growing, it's after, you don't pay taxes. And then when you're taking out the money, it's not tax. So it's important to consider these elements. Then you have the non-qualified annuity as well. You have the cash value, which is also really a good plan for those who have very high, maybe S-Corp and S-Corp, where you have high income and high pass-through, right? I won't dwell much on that, but usually when it's growing, it's tax-free. And then when you are taking out the money, it's also tax-free. Excellent, excellent retirement strategy. I'm sure Amy would shed more light on this, but this is a really good plan alongside your retirement strategy. And health savings account is one of the best, but obviously the IRS knows that is good, but then they limit that. Whereby at seed, okay, I've seen this question. I'll take this. I'm almost getting to there because oh wow, time has gone. Okay, so the health savings account as well. Everyone needs to have that. It's not much, but every year, for the family, you can put up to 8,300. And if you're single, for the 1,500, it's tax-free, it's growing tax-free. When you are taking the money out, it's tax-free. So you can imagine every year, in addition to your W-2, you have that for the family. Okay, next slide. Okay, so I talked briefly about over the years, right? Because people think that they earn less when they are growing older. But nowadays, particularly as high income earners, we are still earning quite a lot. So you have to think of two things, right? When you're thinking of your retirement. One is about what rate is my income going to be? For some of you may want to retire and go back to Nigeria and it's really just capital gains or maybe rental income and all that. And maybe your tax bracket is low. And then you have a different tax strategy. But then you also have to think about in the coming years, are the tax rates going to be high or low? Next slide. Over time, we have seen that actually tax rates are the lowest right now, and it's likely it's going to increase. The Democrats likely will increase. You know, there's this, several of these, the past acts will expire by 2025. So it's likely that taxes will increase, right? So then that means that you should consider then doing tax-free investment, taxable investment after tax or after tax investments now to be able to get rewards or the returns tax-free. Next slide. Okay, no, before then, yeah, we have just 14 minutes. Just make sure I've covered everything. Talked about the Roth. Okay, yeah. So well, it's not the 10th, the 11th is missing our service, right? We provide holistic top-down approach. And really, if you are a tax person or your accountant or your partner, tax partner, and I call them your financial partner, is doing, you're having these proactive meetings, fine. You need, and if you're not, ask for it. Like now, October, November, ask for a tax planning meeting with your accountant so that you review where you are. Review your financials right now. If you're W2, look at your year-to-date income. Where am I? What are things I could do right now? Am I maxed out on my charitable contribution? Do I have an HSA plan? Of course, with the W2, the options are limited, which is why I would advise, you know, looking at passive income, even for long-term, you know, where you get rental property and all that, because there are ways then you can obviously pass through a lot of expenses through that. Next step, next slide. Again, the summary download, I'll just put that in where you can get that. Let me put that in the slide so that we can have some time for Q&A. Let me put that in the chats. So you can get more information around what we just, those 11 things that I talked about. I'm offering, right? If you do want to review your taxes and just kind of see how that is, we can look at that. If you think you're overpaying and you missed out some tax deductions, we can look through that. And you schedule a time for us to kind of look at that. Usually it's like 2 years we look at and see if there are things that, if actually 3 years, because you can always go back 3 years and do that. Next slide. What did the cardiologist say after the tax seminar? He says, remember, it's good tax plan is like a good EKG. It's all about finding the right beats. So we need to find the right tax deductions that are possible, things that you are leaving off the table. I was reviewing a return, and I was reviewing a return of a new client, and there were several deductions that were not taken, right? So it's important that you, one, take responsibility. You are the one paying this money. Take ownership. Don't just say you leave it with the accountant and at the end you just now look at the no. Ask. If you don't understand, ask, because you are the one who is paying that 1/3 or more in taxes to the IRS, where you could avoid it to about 15–20%. And let me pause here for questions. Thank you. Can you next? Yes. Thank you again for giving me this time to share some insights. Let me start asking some questions, answering some questions. I want to be mindful of time.
Sure.
Okay,
Nneka,
so for
thank
S
you.
Corp, can one wait till the end of the year to pay your tax if you are not ready to? Absolutely. I would say I do that. I do that towards the end of the year when I've calculated everything. I just took one W-2. That's after the fact. Because again, as business owner, you want to manage your cash, right? So you just know that, yeah, so quarterly or at the end of the year. I would say really anytime, really, just know that by December 31st, you have your W-2. And it's important even for those who are looking at expanding, right, that you have your W-2, a good W-2. for looking for
Uh,
loans because they look at your W-2 and your share of business. So yes, you can.
Nneka,
And the good
thank
thing
you
about
very
that
much.
is then you don't pay, you will not pay penalty on the 941. 941 payroll taxes till the end of the year. You pay it in January because you've done one W-2 at the end of the year. Yes.
Nneka, can you hear me? Thank you very much.
Okay.
Nneka, can you hear me?
I
Go
can,
ahead, yes,
yes,
Stanley,
I
go ahead.
can.
Go ahead.
Okay,
Yes.
I will. Sure. Annie, did you have anything to add before I get to the rest of the question and answers?
Sure. Real quickly, Nneka, thank you again. This is difficult work in reality. I can't stress that enough. You need experts to handle these things. Tax planning is an imperative for everybody that's here that's a high income earner. An income earner, period. Tax planning is an imperative. You can see all the things that you don't have any clue about that she talked about. This is why you need them. One thing Nneka offered here is an invitation to you to get a no obligation second opinion. This second opinion would give you an opportunity to see what gaps, holes, and things like that are in your current plan. Again, it's a no obligation. That's the QR code that you have access to. It takes you to her calendar. I'm going to say a couple more things real quickly. One, ANPA Foundation. At ANPA Foundation, one of the reasons we do this is to educate you. The reason we're talking taxes and tax planning today is because it's time for you to really pay attention to tax reduction solutions and strategies. One of the things Nneka talked about is the 170, Section 170 of the tax code, which basically is charitable deductions. ANPA Foundation has an ANPA Foundation 100-100 club that you can implement today. You know, you can put, donate $1,000 a month. That's $12,000. You get a tax deduction depending on your tax bracket. That begins to solve and help ANPA realize its mission. These are the kinds of things that we're talking about. So here's a call to action on behalf of ANPA Foundation, my friends. Whether it's $100 a month you want to contribute to, we've got an automated system that you can enroll, and this thing comes out of your credit card every month, whether it's 1,000, whether it's 5,000. That's going to save you on taxes. That's the kind of stuff we're talking about. So I really implore you to, one, follow the advice, use her services. And Stanley, I'm going to turn it over to you.
Thank you very much, Annie. There are some people who are on the call that their name is not on. So it says Zoom user. I'm going to remove them because I don't know if the people, if so, put your name so we know who you are. I'm going to remove anyone that name is not not on the thing. So one is removing some people that are not supposed to be here.
There's a, can I ask,
Just
there's
give
a
me a
question
minute.
out there. Do I take it?
Yes. Go
Okay,
ahead. Go ahead and
so,
take the question. I'm just removing some
okay, so
unauthorized.
wait or answer.
Go ahead and answer.
Okay, so how do you determine your effective tax rate? Is there a formula? Absolutely, there is a formula, but the system already does it from your tax return. Usually, you should always look at the comparison. I usually start with that actually in reviewing a return. The comparison, your 3-year return. At the bottom of there, it talks about your marginal rate and your effective rate. Your effective rate is kind of like your total tax divided by your total income, right? And it's not necessarily your marginal rate. You remember in the table that I shared, the first X amount was 0%, then 10%, so it's kind of like average of all of that. So the goal is always to try and reduce what your effective rate is. Well, first, reduce to your marginal rate, and then overall effective rate should as much as possible be reducing. Of course, when you earn more, right, your effective rate will be going up, but it's good to watch that so that there's no big jump. And even if there's a jump, you can explain. And in that comparison, you're able to see differences between 1 year and 1 year. And you should be able to explain, oh, yes, I know this one, I had an increase in capital gains because of this. Oh, yes, my income increased because of this. My charitable deductions, and really usually when I review returns for my preparers, that's what I start with first, because I'm then asking, why is there a change? Can we explain the change? So you as the taxpayer should be asking. That's the first thing with your accountant. You go to that comparison page and start reviewing with the accountant line by line. Again, you are the one that signs the 8879 authorizing you to e-file. And if you read that 8879, it says you are the one responsible for that return, not your tax preparer. So it's about taking ownership of this amount, 25, 30% of money, of hard-earned money, right? And not just, so don't wait till the last minute. Now you should be looking at 2024, not to, 2023, the final tax deadline is October on Tuesday, but you should be looking at 2024 now, because this is when you can do things, right? You need to reduce your salary. There's a client who's done so well, but because he's making changes, his net income is low. And I'm going to say, hey, let's take down your salary, because we don't want to pay all the self-employment taxes, so that we can have a good percentage of your K1 coming in. So it's okay at times to reduce your salary.
If I can add to that.
Thank you, Nick. Yes,
Okay,
I
how
would
do we open an-
invite everyone that wants to ask a question, feel free to unmute yourself, or you can raise your hand. I will recognize you, and you go ahead, please.
Just to add to what Nneka just said, she talked about tax strategies result in guaranteed results. Okay, you get guaranteed results. Think about this. If you're in the 30% tax bracket, how much risk do you have to take to get a 30% return on your investment? A tax strategy that basically saves you 30% based on the tax code legally is effectively a return on investment of 30%. So I want you to understand that. This is why tax planning is really important.
Okay. Now, there's a question on the chat also, but I also received a text question. Nneka, this is for you. For the HSI account, talk about how to open it. And the second question is, can you carry over year, or just you have to use it that
Yes.
year?
It's good. That's why it's so good. You carry it over, so it just keeps growing.
So at some point, you can only use for healthcare services, correct?
It's for healthcare. There's a penalty if you don't use it for healthcare. But then what's healthcare, right? So you can determine, yes. But it keeps growing.
So it keeps growing. So you get deduction. Is this for both W-2s or so can small business
W-2 small? Yeah, because it's personal. It affects your 1040, right? In the tax return is an adjustment. So it reduces that. It reduces your income.
And is it easy to access? Do you use a credit card, or how do you?
Yeah. So they have some plans. I'm sure any will be in a better position, but it's very, to set up an HSA.
Okay.
Yeah. Very, very simple. If you go on, yeah, it's yeah.
All right. I just wanted to use the opportunity to invite everyone. The next financial webinar is October 26th, Saturday. It's going to be 12 noon Eastern. Hopefully there's no new conflicts that comes up. This will be based on solar credits for tax planning. Does anyone chats? Please feel free to ask, speak. Somebody. How do you open HSA?
Okay, how do you open? If
Yes.
you have an existing brokerage account, you can do that. If you don't have, I'm sure Enyi can give you. I'm sure his people in his team can also do that, right? It's really very straightforward. It's just setting up.
Enyi, how do you open an HSA account, Enyi?
Yes.
Basically, you can open an HSA account through a bank account or through a brokerage account, like you just said. And
so who do we talk to? I'm sorry, you guys say you can just open it how?
Well, if you call our offices, we can certainly provide you some guidance on that.
Okay.
Yeah, but it's very, and you need to do that before the end of the year.
End of the year, correct.
Yes. So it's deducted. Okay, my code. Okay, okay, you have put that there. Okay.
Yeah.
And
What's
On
the
the
one thing I
slide.
would say?
You have to kind of use your phone to or you
Yes,
can
but I
take
could
take
give you the
a screenshot and save it and then scan it later if you have a smartphone.
yeah, I can put that here too.
On the okay, it's also on the
I've just put that there.
on the chat. Okay. Does anybody else have any burning question about taxes for 2024? I would want to also use this opportunity to thank NECA for being their accountant for ANPA Foundation. So everybody needs to know that she is a true philanthropist, and she is. Thank you for ANPA Foundation. I want to thank you, and I want to do it openly and publicly. Thank you, NECA.
she is doing it, by the way, as a service to ANPA.
Yes, yes. So that's a big deal. I think people should really understand that to do an ANPA Foundation tax is not easy. Any other questions from anybody else about taxes?
Let me say this, if I can.
Please.
Look for professional counsel. We typically will tell clients and friends, give expertise 10 hours a year, and you could at least double your current hourly rate of compensation. Expertise would quantitatively 2x at a minimum what you make trying to make the money. I want to
All
thank
right.
everyone.
Thank you. I want to invite anyone else that have the question. Please feel free to unmute yourself. We're almost done. If there are no other comments or questions, let me see.
I just want to say thank you
Foundation.
to Ms. Neka Nwobi for a stimulating presentation. Thank you for taking up our invite, and thank you, ANPA Foundation and Chief Enyi.
Wasiu, do you have
Foundation
any closing comments? Wasiu, as a co-host, could you close the session for us, Wasiu?
I have the same sentiment. Neka, thank you so much for this stimulating discussion and information that you shared with us. I've actually booked my schedule with you already using your QR code, and I have my date and time already. So looking forward to talking with you further. This is very important that we work very hard as physicians, and yes, we are high earners, but if we could save a few more dollars here and there, it would be grateful and helpful in building that generation wealth.
Absolutely.
So looking forward to talking to you using your services.
Thank you.
Is it a crime to pay less taxes?
No, sir. George Leonard Hand, Supreme Court Justice, said it's absolutely not a crime to pay the least amount. It's an obligation. You owe it to yourself to pay the least amount of taxes legally. And she talked about it also, Judge Rehnquist recently. So my friends, tax savings is your imperative, if I can say that. And NECA said taxes are your highest expense that you don't know about. People are always blind to that. One thing that happens is people think that if they get a tax refund, that they've done a great job. No, sorry. You overpaid your taxes. You gave Sam money and he's giving it back to you.
At 0%.
Yeah, keep that in mind. Thanks, Stanley.
Thank you very much. Well, I want to thank everyone for attending our 29th webinar. The next one, like I said, it will be in on the 26th of October. We'll continue on the year end. This will focus on solar credits. Oh, I'm going to ask NECA, you didn't talk about the vehicles. So some people drive heavy cars. Is there a limit on like the weight of the car?
There is definitely a weight of that, and the percentage used. I definitely would not say you put 100% because technically you don't. maybe 80% deduction on that, right? Not you say, oh no, all the whole 100. So again, your thing is balance and being under the radar. So yes, absolutely. There is.
Neka, can you close? Sorry,
A friend of mine, what do you say, Angie?
I was going to ask her to touch on the Corporate Transparency Act. That's
Oh, yes, I was going to do that.
Oh,
Thanks for
yes,
reminding
that's
me.
a
Yes,
big
I had
deal.
one
That's a
other
big deal.
slide. Yes, thank you for that. Yes. So if you're not aware, it was in my other slide. I'll just, there's coming up of really there's some upcoming beneficial ownership information, BOI reporting. So starting from January 1st, 2024, businesses are required to report information about individuals with significant ownership or control over the business. What is it? It is part of what you call the Corporate Transparency Act, aiming to prevent the use of businesses for money laundering and other illicit activities. And who are those supposed to report? All entities created or registered in the US. So LLCs, corporations, partnerships, or less exempt. And what's being exempt? That you have a large company with over 20 employees. So you are supposed to report this by January 1st, 2025. And new businesses within 90 days of formation, even in 2024, you are supposed to report on that. And the failure to file or false information can result in civil penalties up to $500 a day and criminal fines of up to $10,000 per time. So I advise that you ask your accountant or your tax preparer about that, right? So that you can be up to date, right? Before January 2025. There are some people do that. There's a Nigerian attorney, Owe Bele, he's doing that. We're doing that for our existing clients. Or you could go there. If you go to finren.gov, you could do it yourself. For those who want to do it. It's not difficult. It's just your name. It's called BOI. You can just do a search for that. It's called Beneficial Ownership Information Reporting. And the website is
Neka, can you put that on the chat? Because a lot of people are not aware of it.
yes.
They don't understand, especially if you have a lot of entities, you need to report.
Exactly.
It's coming up very soon. The deadline is coming up at the end of the year.
It's coming up very soon. Yes, I had it on my updated slide. Yes, so I've put so you need to be asking your accountant, hey, I need to file this, or you do it yourself. If you have an assistant, can just do that. There's short videos and all of that, on the website. I've put the website there. FinCEN ID. In our conversation with other CPAs and accountants, we've talked, is this going to go away? Because it's just an extra bothersome thing, but we don't believe it's going to go away, and they're really going to really get on it. Yeah, things may be a bit easy now, but it's not going to go away with all that is going on, right, globally. So it's here to stay.
Okay.
So it's called Beneficial Ownership Information Reporting. So even if you have even an LLC that you're not using, but the fact that it's still active, you must do it. You must have that.
This is very important. If there's anything that you get out of this talk today, go to the chat, copy that, check it out. It's very important. I did not learn about this until many, many months ago. If you have a lot of entities, I highly recommend that you probably hire, either some lawyers are doing it, some accountants may be doing that. There is a charge to do it though.
There's definitely.
Neka said you can do it yourself. Do you recommend that we do it ourselves?
It depends on the level you are and the time. Again, think of your bandwidth and how much. I know like Bella is charging about $350 per one. And of course, if you have many entities, there's probably going to be a discount. We will do it for existing clients, but there is a charge for that. You think of your time to learn it and all of that,
Yeah, it's very complex.
Exactly. You have to read the video.
I was like, I don't want to make a mistake.
Is that where you want to spend your time, right?
Yes,
that's the thing, right? So, you can do it if you spend hours to read it and all that. And yeah.
Just because you can do it doesn't mean that you should.
Exactly.
Sometimes.
That's the word. Yes, exactly.
So that's it's
called Beneficial Ownership Reporting. Ownership information reporting. And that's really true. Like how they did where you do, it's kind of like where if you transfer 10,000, right, or have something, you know, over 10,000 bank accounts and stuff like that's part of what corporate transparency now, because people have been using entities, right, to launder money, and also now they want to know the, yeah.
Okay, I'm gonna put the scan up
Oh,
again.
okay, sorry, ANPA
I'm-
mid-Tennessee.
Yeah, I'm putting it back. We have to end because there's
Okay.
other ANPA events coming up. But
Yeah.
thank you, everyone. This webinar is being recorded. We are going to post it on the ANPA YouTube page at ANPA National. So if you go to YouTube page, just type an ANPA webinar, you're going to see the past 29 webinars, all recorded within an hour. You should listen to it. There's a lot of information there. Thank you, everyone from Lagos, Nigeria. I'm actually specifically at Eco Hotels right now. I want to thank everybody for showing up on time. And Neka, thank you for a wonderful information. Enyi, thank you for your guidance in the future. Dr. Wasi, I just thank you for being available to us as well and being my co-host today. We are so happy that there was no technological issues here, so
Yes.
no network issue. Thank you.
Thank you. Bye. Thanks a lot for
Thank you.
having me. Appreciate that. Thank you. Bye.